Fixed mortgage rates increased for the first time in months this week, and variable rate discounts are on the decline, even though the Bank of Canada rate is expected to go down even further in the coming months. And a lot of this has to do with tension in the Middle East, which is sparking fears that oil prices could increase well over $100 per barrel, which of course leads to inflationary pressure and an expectation that interest rates may not come down as much as expected. And in today's video, I'm going to discuss what's going on in the global economy that's affecting Canadian mortgage rates and tell you exactly where mortgage rates ended up this week and where we can maybe expect them to go. But before we get into it, my name is Nolan Matthias, and if you want the latest Canadian and real estate news, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video and so that you can get the latest updates. Okay, so what I'm going to do is I am going to jump you into the news articles here, and we're going to take a look at what's going on with interest rates and what affected the cost of funds with respect to fixed interest rates that saw our first increase in quite a while. So we're going to start by taking a look at this article from investing.com. Could Middle East tensions push oil prices above $100 per barrel? And yes, oil prices did go up. I'll show you more on that in just a second here. But they did go up this week, which led bond yields to go up as well, with expectations that the fight with inflation may not be over yet. Because obviously, if we see higher oil prices, we could end up seeing higher inflation, and that could cause the projected direction of interest rates all over the world to alter course and maybe not end up having interest rates go as low as previously expected. But one economist, one expert is saying don't expect oil prices to remain elevated, primarily due to the fact that when there is tension in the Middle East, it tends to go away. And when it goes away, that tends to see oil prices come back down. Now, the question is, how long will the tension in the Middle East between Iran and Israel last? And if it is an ongoing thing for quite some time, it could affect oil production, and that could, of course, affect inflation, which is why we saw that slight bump up in fixed interest rates this week. So let me show you what was going on. So in Canada, mortgages are very much priced off of bond yields. The higher the bond yields, the higher the mortgage rates. So when we take a look at 2, 3, and 5-year bond yields, what you can see is, again, this last week, these bond yields came up, and they came up quite significantly. And this caused lenders across the country to increase their fixed rates, albeit perhaps temporarily. And you can see that this very much lines up to what happened with the price of oil. The price of oil spiked, bond market yields spiked, expecting that it could cause inflation, and therefore the expectation of where interest rates were going to go got a little bit higher than it was in the week before. And this, of course, led the pricing of mortgages to be higher, which led to many lenders increasing those fixed rates. Now, this is why it's so important to have a good broker, because if you have a good mortgage broker, they will put in rate holds for you, and they will protect you from the potential rises in interest rates that can happen even in a declining interest rate environment. So if you can get a 120-day rate hold, you can pretty much insulate yourself from temporary increases in interest rates. Now, if you need a great broker, my team at Mortgage 360 can help. Just go to mortgage360.ca, hit the apply now button, and we'll make sure that you're taken care of. Because all too often, we see people get mortgages, they get pre-approvals that don't come with actual rate holds, and subsequently, when interest rates do spike, they find themselves paying more than they should have had to. So make sure you've got a great broker. Now, with respect to interest rates right now and where that leads us, well, let me show you what's going on with 5-year fixed mortgages, variable rate mortgages, and then I'll show you the discount mortgage rates at the end. So with respect to 5-year fixed mortgages, you'll notice that 4.54 is lower than the last time we did a rate update in September. However, this is slightly higher than where interest rates got at the end of September. But you can still get a very well-priced mortgage, full feature. And what I mean by full feature is these are non-bank mortgages. These are the mortgages that have the best features, the lowest payout penalties. Remember, B is for bank. B, lenders are the banks. They don't have the best products. The reason they don't have the best products is because for all of these other smaller mortgage companies like First National, MCAP, CMLS, who have the absolute best products in the market, for them to survive, they need to actually have better products. And one of the ways that they do that is by having lower payout penalties. So if interest rates do continue to go down over the next 2 or 3 years, and you take a 5-year fix today, with those types of lenders, you potentially have the ability to get a lower rate midterm, refinance, switch to a different lender, and get a better deal. However, if you have a mortgage with a B lender, with a bank that has a high payout penalty, well, you're pretty much going to be stuck. And yes, there's things that banks do in order to trick you, to make you think that you're getting a lower interest rate midterm. They'll do things called blend and extends. But in reality, you're still paying the full cost of the mortgage for that 5-year term when you do a blend and extend. All they're doing is extending your mortgage so you're stuck for a longer period of time and averaging it out with the current rate so that, yes, you're still paying the old price, but you're just getting that little bit of extra tacked onto the end at the lower price, which arguably, depending on what happens in the economy, could end up actually being worse than if you had just rode that mortgage out to the end of the term. Now, with respect to mortgages where you're putting greater than 35% down, you're getting a similar rate, 4.454%, to that insured rate. And then as you start to put less down and you start to get closer to that 20% down payment range, you'll see that interest rates go up. Now, it used to be that if you put 20% down on your mortgage, you got the absolute best rate that was available. But nowadays, the mortgages with the highest risk for a bank, for a lender, are the ones that are uninsured, which means that when you're putting 20% down, that is the highest risk level to the bank itself because it doesn't have insurance. And then as you get closer to that 35% down mark, that is where you find yourself in a situation where those banks, or those mortgages, sorry, are deemed by the banks to be about the same risk level as insured mortgages, where they virtually have zero risk. And that's why you see the pricing be virtually the same. And then if you are looking for a mortgage that is uninsurable, a refinance, or it is at a 30-year amortization, then you are looking at a significantly higher price. That price says 5.94. That is not where that should be. It should actually say 4.94%, which is still better than it was before. Now, there are some caveats to this. You can now get insured mortgages up to $1.8 million. Of course, on some mortgages that are insured, you can now get 30-year amortizations. But it really depends on the product that you're looking for and your personal circumstance. So again, this is where having a great broker comes into play so that you know that you can get the best product, which typically isn't going to be the one from the lender that you currently have, but one from a lender that has access to all kinds of different products and has access to all of the CMHC and all of the SAGAN and all of the Canada Guarantee products. Now, with respect to 5-year variable rates, this is where you start to see the prime rate, yes, has gone down to 6.45%, but you're starting to see discounts go up. So it used to be that you could get prime minus 0.95. I guess I should say discounts go down. Now you're looking at prime minus 0.9. So the discount has gone down, which means the interest rate that you pay has gone up slightly. So right now, if you were to get a 5-year variable rate mortgage, you'd be looking at 5.55%. In the middle of September, you would have been looking at about 5.5%. So not a big difference, but they are pulling back those discounts a little bit. Then at 35% down, you're looking at the same price. 30% down, you're looking at prime minus 0.75. 25% down, you're looking at prime minus 0.6. And again, at 20% down, you're looking at prime minus 0.6 again. And then if you're looking at those uninsurable mortgages, you're looking at prime minus 0.4, which hasn't changed since last month. Now, I'm going to show you the discount mortgages. I'm not going to go through these in detail. The reason why is because what's more important is the conversation around discount mortgages. So discount mortgages are the mortgages where they come with some sort of restriction or some sort of stripped away feature that makes it so it is more likely that the mortgage is going to be profitable for the bank. One of the most common ones is what's called a bona fide sale clause. This is, in other words, a no refinance clause. The only way to get out of the mortgage is to sell your house. And what this prevents you from being able to do is get a lower interest rate if interest rates go down. That's why they're willing to give you a discount, is because they know that you're stuck for the full 5 years, and therefore are going to end up making more money. So just like everything else in life, you get what you pay for. If you get a discount mortgage, if you get a really ridiculously low rate or you see one advertised, keep in mind that it comes with a catch. And by the way, if interest rates do go down, you're giving up, just like if you were to get a mortgage at a bank, your opportunity to get a lower rate later on down the road, which means that the savings of 0.2% or 0.3% could end up being significantly less than what you could have had if you had a full feature mortgage, where you're able to get a 1% reduction or maybe a 2% reduction somewhere down the road and save tens of thousands of dollars as a result. So keep that in mind. You get what you pay for. The lowest rates, especially in a declining rate environment, aren't always the best rates because they could end up actually costing you more money. We always have our 3P rule: product, penalty, price, in that order. What that means is that you should be looking at the product first, then you should be looking at the penalty, the cost of the penalty. Those should be your two primary factors when it comes to selecting a mortgage. And then find the best rate with the product and the penalty combination that best suits your needs, not just today, but in the future. And then if you want to take a look at those variable rates, here they are. Again, discounts coming down. It makes no sense in my mind whatsoever ever to get a discount variable rate mortgage, especially when you look at the fact that if you were to get a variable rate discount mortgage, you lose the ability to switch to a different lender, which means you also lose the ability to have any sort of negotiating power, which means that if you ever decide you want to lock in, you pretty much have to pay what the bank or the lender tells you to pay, and you've got no other options because you can't leave, which means you've got this set of golden mortgage handcuffs that are going to make it so the mortgage is going to end up costing you more over time. And those are the rates for October of 2024. If you want to see more about what's going on in the Canadian real estate market, make sure you check out this video right here.